Morning, ladies and gentlemen. Thank you for joining me. We are going to present around the Centaur funds and our performance and insights regarding that. So let me go straight into the presentation. Just a quick overview on Centaur. Centaur is a retail-only asset manager. That means we only manage unit trust funds, no institutional funds, with 11 billion of assets under management. We had exceptional growth last year, growing 39%. We're also pleased to announce the Centaur BCI Flexible Fund marked its 20th anniversary in December 2023, being an exceptional performer, returning 16% per annum, and being one of the best performing unit trusts in the country. We appointed a new Chief Operating Officer at the beginning of October 2024, Doug Stott. He's got over 25 years experience in financial services. He's a chartered accountant, managing with previous experience as CEO of various asset managers and also international experience as well. So exceptionally a very strong appointment. Very pleased to have him. He hit the ground running, and he's setting the foundation for our next phase of growth over the next decade. Looking at the performance of our funds, the BCI Flexible Fund over the last 15 years has been the #1 ranked multi-asset unit trust in South Africa with a return of 15% per annum. And when we look at the ranking tables, if we look at the top 5, the Centaur BCI Flexible Fund was #5 of all unit trusts in the country over that period, only being beaten by 4 global funds which benefited from the rand depreciation over that period. The Centaur BCI SA Equity Fund was launched in November 2023. Last year, it was the #1 ranked fund in the SA Equity General category, so very pleased at that performance, and ended the year with 700 million of assets under management. Also, the Centaur BCI Balance Fund, it's been ticking away for over a decade now, returning consistently a top quartile performance, as I'll show you, and beating its benchmark. And last year, in a very competitive category with 225 funds, it was the fourth ranked fund in that category. Just looking at the team, I think you've probably seen this before. It is on the website, so I'm not going to go into too much depth. But just on the investment team, which is in the top row, a very stable investment team. The numbers in brackets are the tenure at Centaur, so a nice stable team. But besides myself, the investment team is all under 40, so relatively youthful, but with lots of experience, and that really gives a good road to take us into the future. And I am handing over more and more responsibilities to the team. For example, Nick de Vos is the primary portfolio manager on both the balanced and SA equity funds. Matt King, a new appointment. He's an analyst. He's been with us 1 year, really has meshed very well into the team and contributing very quickly. Doug Stott, who I mentioned in the first slide, is also a new hire. Really, you may ask, what is our edge? So we're a relatively small team. We think a smaller team is better. It facilitates a very rapid communication and quick decision making. But first of all, our edge is really our benchmarks are very competitive. So our benchmarks, if you're just invested in the index, would be one of the best performing unit trusts in their category. Then we look to outperform our benchmark, and we're very competitive in this regard. That's the value we add. So the excess return after fees is the value we add, and we think we have to justify existence by outperformance. Also, outperformance, we do get performance share on outperformance, and that's a key revenue source. So that's very important to us, and also the whole investment team share pro rata in that, so their remuneration is also tied to the outperformance. So we see this really as a partnership type model. If we outperform, Centaur benefits, and so does the investment team. We've also got a highly disciplined process, so we want to take emotion out of this. And this has really been developed since inception, almost 24 years. And we've refined this into a process we call the Centaur Way. It's a robust and repeatable investment methodology. And the whole team is really on board. So we kind of thinking the same way about investments, but we do encourage robust debate. We've also developed various proprietary systems, so our portfolio management system that runs live on our desktops every day. So the unit trusts we can see in real time and make very rapid decisions. So use volatility to enhance returns. Look at the performance of the BCI Flexible Fund since inception. Our first clients, if they invested $1 million on day one, that would have been worth 18.8 million at the end of last year. And there are certain clients on this call who have been with us since inception. So we're very proud to have created that wealth and value added for our clients. We don't have definitive data, but probably over that period, we could actually be number one in the country out of all unit trusts. Just looking at our ranking, consistently top quartile, and over 10 years, number one out of 31 funds. Over the period, we've won multiple awards, which is on the right. The Centaur BCI Balance Fund, this was launched in 2023, starting to deliver consistent, excellent returns. It's a very crowded category. The last 10 years, we're pleased to return 10.1%. I think it has been a very difficult period for financial market returns in South Africa. Nonetheless, we look to outperform inflation +4%, and over that time, we've actually delivered inflation plus 5.2%, which we're proud of. And we think in tough times, if we can deliver our targets, the good times take care of themselves. You can see over 10 years, 4 out of 101 funds in its category. The BCI SA Equity Fund, we did highlight that we've got very strong SA equity skills, and we've consistently delivered alpha within South Africa, and we've displayed it here where we were the number one performing fund for 2024, and also outperform our benchmark by over 10%. Just looking at the flexible fund where the returns came from, you can see on the right the value added. So fixed income, we were slightly overweight. The reason we were overweight is there were very, very strong inflows into the fund, particularly in the third quarter. We were marginally underweight South Africa as we were looking to deploy these inflows favorably. So we're slightly underweight, but fixed income, we managed to outperform our benchmark by almost 2%. Local equity, we were underweight at 48% versus a benchmark of 60%. Nonetheless, we outperformed by 5.4%, and the net value added was 0.9%. Offshore equity, we were overweight there, so that was positive, and offshore we managed to deliver a return of 34%. We had some great stock picks, particularly down flatter. They came through, and very strong value added there. So if we combine it, the net value, the gross value added was 6.2%. Fees and reconciliation -2%. Net outperformance 4.2% in the A class. Just looking at some of the biggest contributors and detractors, 2 offshore shares, both Dell and Flutter. Dell got caught up in the AI hype. At one stage, it performed so well, it actually went to 8% of the fund. We used price strength to dramatically lighten using savvy trading. By year end, we had substantially de-risked that position. We think it's largely played out, and it was under 3% at year end. Truworths performed well with lower interest rates. we did take a lot of profits over 100 Rand in the fourth quarter. Wilson Bailey, that performed well, similarly took some profits there, and OUTsurance also a strong performer. It moved into the index. We used that strength around 69 Rand to lighten our exposure there. The tractors, we were underweight resources, so we had no platinum exposure. That was a bad performing sector. So our underweight resource exposure was positive, but our two worst performing stocks were in the resource category. Sasol, very disappointing. I see subsequent to year end, it is up about 20%, so some recovery. And African Rainbow Minerals down 18%, really in line with other platinum stocks. Aspen, slightly disappointing. We did lighten in the third quarter and a negative contribution there. And this then just rounding it off with BMW and Remgro. I think you may have noticed that we altered the benchmark, and you may ask the question why. I think if you look at the red highlights, so our SA equity content has moved down from 60 to 50% in the flexible fund, and offshore component up from 20 to 30%. So we've actually increased the offshore component. Similarly for the balance fund, we've done similarly. And you may ask the question why. I think the two primary reasons is in 2022, there was a change in regulations. The Reg 28 changed, and we were allowed to invest up to 45% of the fund offshore from 30%. So that gave us capacity to change the weightings. And then also when we did statistical back tests, looking at the risk reward of investing more offshore, we found it was more optimal over multiple time periods to have a higher offshore weighting. So the benefit to you on the flexible fund, if we look historically on the benchmark instead of 9.1%, this is to the end of September, would have moved up from 9.1 to 10%. So an extra 1% on the benchmark. And you can see the standard deviation, which is a classified, which we constitute risk, has moved down. So you're getting both an increase in return, in expected return, and a lower risk. Similarly in the balance fund, very similar story. So that's really the reason why. As I mentioned, in what is our edge, we look to outperform very competitive benchmarks. That's our starting point. And then the alpha above that is the value added. We're looking to make as much returns within our risk profile for our clients. And this really, we think, is beneficial to clients in the medium term. Just looking at the SA economic outlook, I think with the Trump presidency and just in the last 2 months, maybe slightly not as positive as 3 months ago. I think the positives remain. The government of national unity developments are positive for confidence and economic stability. But on the negatives, really the stability is very contingent on the government of national unity holding. I think end of Eskom load shedding improves confidence, but we've been surprised that the net benefit to the SA economy hasn't been stronger. We haven't had load shedding for almost 300 days. It hasn't had as much impact on the economy as we expected. The other positive, lower interest rates. So we've had 0.5% cut. There's also stimulus from the 2-point retirement withdrawals. And we have noticed an upturn in spending in both October and November. But then on the flip side, I think the Reserve Bank has really missed a lot of the window to cut rates. They've been more conservative than the US. They could have followed the US rate cutting cycle. And really they've missed the window to cut rates. So interest rates are going to be higher than we anticipated only 2 months ago. Then an added negative, really the weak municipalities are undermining growth. We know there's water problems across the country, really, and really Eskom collections are way behind schedule. This is really a consequence of weak municipalities. So between 2025 and 2027, we're looking at between 1 and 2% real GDP growth, potentially with upside potential in the medium term. We still think on our stock picking with the alpha added, we can deliver South African equity returns of 15% per annum. In the flexible fund, we did 19% last year, and we think 15% is readily achievable. Just looking at the Rand, this is quite a busy graph, so let me try simplify it. We base our Rand on purchasing power parity, and there's really been two regimes. When South Africa was investment grade up to 2013, we based it around that fair value purchasing power parity. In late 2013, South Africa was downgraded to speculative grade, and then the Rand is traded at a 20% discount to that fair value. So using this model, our fair value is 1735, but I think the Rand, the dollar is going to be strong, so it'll probably trade, the midpoint would expect close to 1820 to 1850. So that's really where we see the Rand. Themes, we think there's going to be an upturn in gross domestic fixed investment. There's a massive backlog, particularly in water infrastructure, over 1 trillion backlog. Eskom also has to reconfigure its transmission network, 300 billion there. And we can see that the listed construction firms' order books are full, and Sanral, for example, has up spending by 80%. So there is an upturn there. We do have investments in PPC and Wilson Bailey Homes. Those performed exceptionally last year. We did take money off the table, so we reduced exposure. They are less liquid, but we still have 4% weighting in these two counters in the flexible fund. Just looking offshore, the US valuations are elevated. So we've had 2 years of 25% returns from the US. The forward P currently is 23 times. That is elevated by historic standards. And history suggests, backtesting suggests the US equity market will deliver low real returns over the next decade. Also, what is of concern is the US 10-year bond, which is approaching 5%. That's hell of a headwind for equities over the medium term. I think we are valuation cognizant, but I think timing a downturn is fruitless, and what we've seen is often momentum will take shares way beyond fair value in the short term, but in the long term, the performance may not be as good. We are underweight the US, but we do have exposure via flatter down Microsoft. Looking at certain themes, so one we think is attracted is food delivery, really an internet subscription type business. So during COVID, this really spurred rapid adoption. Shares rose rapidly. So you can say Meituan, which is a Chinese listed company, went up over 4 times. Delivery Hero went up 2 times. But subsequent to that, it was overhyped, and the shares came crashing down over 75% off their peaks. But now we do find that the industry does have very attractive economics. So it's a switchboard business connecting buyers and sellers. Once you've got scale, there's really massive benefits for leaders, and you have an entrenched client base. It's very capital light. And once you've got this client base, there's the ability to add incremental revenue streams, which enhances profitability. The industry revenue, which you'll see on the subsequent slide, has been growing at 35% per annum over the past 5 years with increasing margins. So we think this is a rapidly growing industry and is an attractive place to invest. The food delivery operators reached an inflection point early in 2024, and 3 operators stand out for us. Prosus, we did buy a new holding. Its biggest investment is Tencent, but around 20% of its valuation is food, and this is really where the thrust of new investment is going. And we like what management's doing, and it has very strong market positions, particularly in South America. Delivery Hero is one we've started nibbling at. It's a leader with a 60% share across multiple regions and growing EBITDA strongly. We see strong growth and improving profitability from that. And then Meituan is the king of China. That has very high margins and also growing strongly. So we're watching that. The ones we've invested at this stage is Prosus, a smaller position to Delivery Hero, but we'll use price volatility around the trunk regime to upweight holdings in these counters. So investment strategy is we expect a year of volatility and excellent trading opportunities. So we'll harvest that volatility to improve returns. We're mindful of US valuations and underweight. We think there remains room for South Africa Incorporated to continue delivering good returns as we highlighted. However, I think the incremental news over the last 2 months has been negative. We continue to be overweight our strategic fixed income asset allocation. We think inflation is going to remain relatively low, and 10-year bond rate of returns over 11% are attractive with inflation below 5%. We slightly underweight offshore. We are going to look to upweight that exposure into our target ideas opportunistically. So looking at the asset allocation of the flexible fund, the benchmark on fixed income is 20%. We're very close to that. So we are basically on benchmark on equity content. The equity content moved up 7%. So both into JSE equities and world equities. We were very active in the second half of last year. We got out of a lot of more mature ideas, slower growers, which we felt had played out, and moved into higher growth opportunities, which I'll explain in a later slide. Just looking at the balance fund, a similar story. The equity content moved up 2% with JSE equities. So the key purchases there, we bought Northern into weakness. We had no platinum exposure. It fell out of the index, and we used that price pressure to top up. And the other offshore, the other share was Boxer, which we bought there. We also bought a 1% holding. I think we will look to upweight world equities closer to our benchmark opportunistically and slightly reduce JSE equity content. SA government bonds, we're slightly overweight. We're 2% overweight, but we are underweight duration. So on a duration adjusted basis, we're probably about 4% overweight relative to our benchmark. Cash and cash equivalents below benchmark. Just looking at our biggest holdings, Prosus is a new holding last year. It performed well. What we like about this is really the new CEO has come in. He's cleaning up the business, simplifying it, focusing on profitability, and we see our results happening very quickly. They're also doing a massive buyback, so they're buying back about 10% of their business per annum by selling down Tencent. That is adding around 3 to 4% incremental value. And so we're happy to hold this, and we've actually used volatility to really top up in January. ABSA, we consider this undervalued. We think a new management team should drive performance improvements. So we purchased this below book value, and we think it can deliver returns of 15% per annum. Truworths was a very strong performer. We did lighten significantly. We think it's approached fair value. So this one's partially played out, and we are in a lightening process. First Strand, this is a core holding. It's got a return on equity of 20%, been a consistent long-term grower. It has been under a bit of pressure. We think it is priced to give good returns and happy to hold that. Aspen, a little bit disappointing. but we do see multiple growth vectors, particularly weight loss drugs. They've made various acquisitions, which will come through over the next 2 years. They filled capacity with new contracts, and they're building up a bridgehead in China, using current weakness to buy there, and that's going to be a contributor in the medium term. Looking at offshore equity holdings, Exor's been there for a while. Good value, trading at a 40% discount to sum of parts. I'm just going to focus on the more topical ones. Flutter, it's a global leader in online sports betting, the market leader in US, which is growing over 20% per annum, an exceptional performer, and happy to hold that. We classify that as a dynamic value creator. Dell performed exceptionally. We did lighten considerably, more than halving our position over the year. And we think that's, that has fallen a bit, so can still offer fair returns from here. And then the other one, a new one, is Trip.com. We bought this last year, and we bought this at depressed levels at only 12 times earnings. It's a very strong cash generator. It's like Bookings.com. It's the leading travel aggregator in the Asian travel industry. Penetration is growing, and we expect that company to double profits over the next 5 years. That is up, at year end, was up about 50% on our purchase price. Just concluding, we think there's still scope for South Africa to perform, but caution against an overly conservative South African Reserve Bank. We see upside from structural reforms, but we think these will take time to play out. We expect greater volatility, and we'll use this volatility we'll harvest this volatility to enhance returns for the portfolio. I think we are small enough to be nimble, but really large enough to be robust. And over the medium term, we're looking for the Centaur funds to continue outperforming their benchmark. Thank you very much. That concludes my presentation. I'll take questions now.
Is the suggested investment tilt for 2025 towards SA Inc. or global equities, and why?
I think we are going to invest close to our benchmark. So we'll try use the Rand volatility to create alpha with Rand trading. But we are seeing some attractive offshore opportunities, and it's easier to scale into those. So I think we're going to look to be marginally overweight relative to our benchmark. So in the flexible fund, over 80% equity content. And we're going to look at offshore around 30% of the portfolio, locally slightly above that, maybe 52 to 55%.
Are the US equity markets in a bubble?
We think they are very highly valued. I think one must bear in mind that US equity profits are boosted by the 6% deficit in the US. And with the higher US bond rates, that's going to be harder and harder to fund. So we think that is a big risk factor, and that deficit may have to be reined in, which will suppress our corporate profitability and a headwind to US growth. But it's very hard calling tops, but it does look fully valued.
What's your outlook for resources if Trump imposes tariffs on South Africa?
I think tariffs are very much a China story. So if they're tariffs, I think it's not going to affect locally so much. I don't think he's going to put tariffs on platinum or gold or coal, for that matter. But it's really the impact on China, and I think we have to look at that on a case-by-case basis. Really China's demand for things like iron ore is reducing. So even without Trump, the outlook is not particularly exciting, and really demand is changing into new metals, lithium, for example. But even though demand is very strong for lithium, there's oversupply. So I'm not wildly excited about commodities, but I think it has to be looked on a case-by-case basis.
What's your outlook for dollar bonds as prices have been negative or below expectations for a while?
Yeah, I think dollar bonds, I mean, that's a very hard call. I think they're trading at 4.8%. I think inflation could be towards the high end, maybe 3%. I think the market's also concerned about the deficit. So I think it's a hard call, but I can't see them being exceptional performers. I don't think they're going to re-rate materially. There's probably still scope for them to de-rate. But if you buy shorter dated bonds, you can get about 4.5%, 5%. So a 5-year bond is safer, and you should be able to get a return over 5 years of close to 4.5%.
What, if anything, will turn the fortunes of US large cap shares, which for most part has been the only game in town?
I think that's a hard call. I think, if their profitability starts waning or they report bad results. So it's really, let's say Nvidia has a poor print, so demand's very strong, but let's say it starts cycling over higher levels and margins come down, that could be a catalyst for a big fall. So I think poor performance, underlying results would be a catalyst for those offshore markets. But I think, there is a very strong trend towards indexing, and that's ongoing, and that just results in a wall of money going into these very large caps. So that is a headwind for any, that's part of the reason that they continue to perform so well.
While domestic equity valuations remain attractive, there remains anemic growth. Are double-digit returns realistic for 2025?
I think double-digit returns are positive. I think we're looking for reasonable earnings growth and dividend yields around 4 or 5% on many counters. So it doesn't have to do that much to achieve double digits. But having said that, one has to be very selective and find companies that are growing in this environment, and can deliver that. So one has to be selective in that regard. Well, that concludes the questions. Thank you very much for joining me. Centaur is looking to continue delivering outperformance and remain one of the best performing funds over the medium term. Thank you very much for your time, and thank you very much for your custom. Thank you.